Hey, welcome to this week's video. The purpose of this week's video is to get the IRS to owe you money. Of course, the IRS isn't going to necessarily cut you a check, although maybe in the right circumstances they could, but you'll realize the cash when you pay less in taxes. And so this video, I'm going to give you 6 powerful business tax deduction strategies that you can easily understand and better yet, implement before the end of the year. So let's get to work. The first strategy is to prepay expenses. You know, IRS regulations contain a safe harbor rule that allows cash basis taxpayers to prepay and deduct qualifying expenses up to 12 months in advance without challenge. You can only prepay 12 months of qualifying expenses under this safe harbor rule, and you must be a cash basis taxpayer, which means you record income and deduct expenses as the income is received and the expenses are paid in cash. Qualifying expenses include such things like lease payments, business vehicles, rent payments, machinery, and insurance premiums. So let me give you an example. Let's say you pay $3,000 a month in rent and you'd like a $36,000 deduction this year before next year. So on Friday, December 31st, you mail a rent check for $36,000 to cover all of next year's rent. Your landlord does not actually receive the payment in the mail until the following year, say January 2nd. And here's the result. You get to deduct that $36,000 that you paid. The landlord, even better, reports that taxable income in the next year because they received that check in the next year. And they also have to be on a cash basis method of accounting as well. And most businesses are. So you get what you want, the deduction this year, and the landlord gets what they want, next year's entire rent paid in advance, eliminating any collection problems while keeping the rent taxable in the year it expected to be taxable. The next one is to stop billing customers. And this is a rock solid, easy strategy to reduce taxable income for the year. You just stop billing your customers until after December. You know, customers, clients, patients, insurance companies, they generally don't pay until billed. So not billing customers and patients is a time-tested tax planning strategy that business owners have used successfully for years. So let me give you an example. Let's say Jim, a dentist, usually bills his patients and the insurance company at the end of the week. This year, however, he sends no bills in December. Instead, he just gathers those bills and mails them the first week of January. And the result is he just postponed paying taxes on his December income by moving that into January. Another strategy is to buy equipment or office equipment. With bonus depreciation now at 100%, along with increased limits for what they call Section 179 expensing, basically you can depreciate or write off equipment. If you buy your equipment or machinery and put it in place before the end of December, you get a deduction depending on your tax situation of 100% of that cost. Qualifying actually bonus depreciation and Section 179 purchases include new and also used personal property such as machinery, equipment, computers, desks, chairs, and other types of furniture. So it's wise to first check with your tax accountant to make sure that when you're purchasing that equipment, it will be deductible and you'll be able to get that 100% expense deduction. But in general, you're going to receive that and be able to deduct it before the end of December. Another strategy is to use your credit card. If you're a single member LLC or a sole proprietor filing in Schedule C in your personal tax return for your business, the day you charge a purchase to your business or personal credit card is the day that you deduct that expense. Therefore, as a Schedule C taxpayer, you should consider using your credit card for last-minute purchases of office supplies and other things that you need before the end of the year. If you operate your business as a corporation and if the corporation has a credit card in the name of the credit card, the same rule applies. But if you don't have that for your corporation, and you operate as a corporation, you can use your personal card still to make those purchases, but the corporation must reimburse you if you want the corporation to realize that tax deduction, and that has to happen before the end of the year. Thus, submit your expense report and have your corporation make its reimbursements to you before the end of December. The next is don't assume too many deductions. And what I mean by this is if your business deductions exceed your business income, you have a tax loss for the year. With a few modifications to the loss, tax law calls this a net operating loss, or NOL. If you are just starting your business, you could very possibly have an NOL. You could have a loss year even with an ongoing successful business. What you used to be able to do is carry back your NOL 2 years and get immediate tax refunds from those prior years if you had income in those prior years. But under the Tax Cuts and Jobs Act, that's eliminated this provision. Now you only carry your NOL forward, and it can only be used to offset 80% of your then current taxable income in that future year. So what does all this mean? It means basically you should never stop deducting your deductions, and you should always claim all your rightful deductions. We have spoken with far too many business owners, especially new business owners, who don't claim all their deductions when those deductions would produce a tax loss. The next is qualified improvement property. In the CARES Act, Congress finally fixed the qualified improvement property error that it made when enacting the Tax Cuts and Jobs Act law. Basically, qualified improvement property is any improvement by you to the interior portion of a building that you own that is non-residential property. Think, office buildings, retail stores, shopping centers. If you place that property in service after the date you place the building in service. The big deal with qualified improvement property is that it's not considered real property, which you would actually then, if it was, you would depreciate real property over 39 years. Instead, qualified improvement property is eligible for immediate deduction or under the 100% bonus depreciation or Section 179, but it's also depreciated. If not, you don't use those. You can depreciate it over 15 years, which is much shorter than 39 years. To get this deduction, you need to put the qualified improvement property in service before the end of December in order to have it in that current year. And also, take a look at prior year tax returns, because if you do have qualified improvement property that you're depreciating over 39 years, you might want to consider fixing that by amending your tax return. So some takeaways from this video is prepay your expenses before the end of the year and deduct it in the current year. Stop billing until next year and then bill the following year. Take advantage of the depreciation rules. Work with your tax accountant to make sure that when you buy equipment that you will be able to 100% deduct that equipment. Also, use your credit card in the right way. Remember that if you are a sole proprietor, you can use your personal card and deduct those expenses right away. But if you're a corporation and you don't have a corporate card, you will have to reimburse yourself before the end of the year if you use your own personal credit card. And don't be shy about taking deductions. Work with your tax accountant to make sure that you get everything that you're entitled to deducted, even if it produces a loss. And take a look at qualified improvement property. If you have that, you might be able to deduct 100% of that and get it done before the end of the year. So that's it for this week's video. If you got any value out of it, it'd be great if you hit that thumbs up. And if you're not a subscriber, it'd be awesome if you subscribe. I will catch you on the next one.